Something strange happens when a market is under real stress. The price you see on a screen can look calm, even liquid, while the price to actually obtain the asset in the real world starts behaving like a different universe. Gold is one of the few markets where that split can show up clearly, because gold trades in two parallel systems at once. One system is paper, promises, contracts, claims, exposures. The other system is physical, bars, coins, vaulted metal that has to be fabricated, moved, insured, and delivered. Most of the time, those two systems track closely enough that the difference feels like background noise. But when the gap widens and stays widened, that's not trivia. That's the market telling a story about friction, trust, and settlement. Let that sink in, because this is where the crossroads appears. When people say gold price, they often assume it's one number, one truth. But in practice, gold price can mean at least three different things. It can mean the spot quote, the reference price most people see. It can mean the futures price, the price of a standardized contract trading on an exchange. Or it can mean the physical acquisition price, what it actually costs to take delivery of real metal in the format you want, in the place you want, on the timeline you want. Here's what needs to be understood right away. Paper gold is fast, it's easy, it's liquid, it's leverage friendly. Physical gold is slow, it's constrained, it's logistics, it's real-world capacity. That difference is why divergence can exist at all. A futures contract can trade hands 100 times in a day without a single bar moving. A paper claim can be created, closed, rolled, netted, rehypothecated, and the system can look perfectly smooth right up until the moment someone insists on final settlement. Paper instruments serve real purposes: hedging, price discovery, liquidity, risk transfer. The problem starts when paper behavior becomes the headline story, and while physical reality quietly changes underneath. So what does divergence actually look like? It often starts small, and it looks almost boring. The screen says gold is at a certain level, but a buyer goes to acquire common physical products and discovers the real-world price is meaningfully higher. Not a few dollars higher, meaningfully higher. It's priced at spot plus a premium. The premium covers fabrication, distribution, dealer overhead, and demand pressure. In normal conditions, that premium is relatively stable. In stress conditions, that premium can expand quickly. A move from a 3% premium to a 7% premium doesn't sound dramatic until the math lands. On a $2,000 reference price, that's the difference between paying $260 and $2,140. On a $3,000 reference price, that's $3,090 versus $3,210. And on a much higher reference price, the premium expansion becomes a real second price, a shadow price, and that tells you what people are willing to pay for certainty. And it's not just retail. In wholesale gold, the divergence can show up as stress around bar formats, delivery timing, and the incentive structure between spot and futures. To make this concrete, consider the plumbing of the global gold market. A standard Comex gold futures contract represents 100 troy ounces. That's the unit of a very liquid paper market, a price discovery machine where leverage can amplify moves. A major wholesale physical format in London is the good delivery bar, roughly 400 troy ounces. In Shanghai, the benchmark system is built around 1 kilogram lots, physical-sized units designed for actual settlement. Those details matter. Because when physical demand intensifies, it doesn't always intensify in the exact format that paper markets most easily deliver. If the market is long on one bar type but short on another, or if refining capacity is bottlenecked, the price can look normal while the real-world availability becomes abnormal. That's how a divergence can begin without a visible alarm bell. Now, here's the key mechanism that most commentary skips. Normally, arbitrage links paper and physical. If paper is cheap relative to physical, an arbitrageur should be able to buy paper exposure, convert it into deliverable metal through the rules of the venue, then sell into the physical bid. That action narrows the gap. So if the gap remains, it's usually because something is blocking the arbitrage. That something is rarely one thing. It's often a stack of frictions: financing cost, storage constraints, delivery timelines, counterparty limits, bar conversion capacity, regulatory restrictions, transportation disruptions, and, most importantly, the difference between a claim and a specific bar. Allocated gold means specific bars are held, identified, and owned outright. Unallocated gold often means a claim on a pool, exposure that functions smoothly until too many people ask for the same thing at the same time. That distinction is not a conspiracy theory. It's a structural feature of how modern bullion markets provide liquidity. And when markets get stressed, structure becomes destiny. This is where the curve and spreads matter. Gold, as a storable asset, often trades with a carry, storage and financing costs. In many periods, futures prices are slightly above spot prices. That shape is called contango. When contango is normal, the market is basically saying waiting has a cost and the price reflects it. But if immediate demand for physical rises sharply, nearby delivery can become unusually valuable. Spreads can tighten. In extreme cases, the market can flirt with backwardation, where spot is above futures, which is rarer for gold and can be psychologically significant because it implies immediate settlement is being valued more than future settlement. Even without dramatic backwardation, subtle shifts matter. If the spread between the nearest delivery month and a later month compresses aggressively, the market is whispering that immediate supply is tight, or that immediate demand is urgent. Connect the dots for a second. A market doesn't need to run out of gold for this to happen. It only needs a tightness at the margin, a mismatch between what S demanded for delivery and what AS conveniently deliverable under existing pipelines. And that's why paper versus physical becomes an early warning system, because paper can remain liquid and tradable even when physical is not. In other words, the screen can keep printing prices while the real world starts rationing availability. History offers clean lessons here. During the 2008 crisis, many markets learned that liquid and solvent are not the same thing. The issue was not the absence of paper claims. The issue was trust and settlement. Spreads widened across finance because counterparties started asking a brutal question: who actually performs when stress hits? In March 2020, the world watched supply chains and liquidity break in unexpected places. Even very deep markets saw strange dislocations, not because the underlying asset vanished, but because the pathways to deliver and transform assets into the right format became constrained. Gold experienced notable friction around certain physical products and delivery logistics, while paper markets continued to trade, fast, emotional, and sometimes disconnected from what real-world buyers were experiencing. That's the historical parallel. Not that today must repeat those exact moments, but that the mechanism is the same. Stress reveals the difference between exposure and possession. Now look at the present macro backdrop, the fuel that makes these divergences more likely. Gold sits at the intersection of money and fear. It reacts to inflation expectations, yes, but more broadly, it reacts to trust in currencies, trust in debt sustainability, trust in geopolitics, and trust in the idea that the global system will remain frictionless. When that trust is high, gold is often treated like a trade. When that trust is lower, gold is treated like an alternative form of settlement, a reserve asset that doesn't depend on anyone else's promise. And when that shift happens, physical demand becomes less sensitive to minor price moves. Not reckless, purpose-driven. That's why a day of paper selling doesn't automatically make physical premiums collapse. Paper can be forced to sell. Physical buyers often choose to buy or choose to wait, based on a different set of motivations. That difference in motivation is where the divergence grows. Now step into the supply and demand fundamentals, the structural layer underneath the daily headlines. Gold supply is slow-moving. Mine supply can't surge overnight. Large projects take years. Recycling can rise at the margin, but even recycling depends on price, confidence, and social behavior. It's held as long-term wealth, cultural savings, strategic reserve, or insurance, because when demand spikes into physical channels, the float can shrink dramatically. And when float shrinks, premiums expand. This is where the crowd often gets it backwards. In calm markets, premiums are mostly a business reality. In stressed markets, premiums become a signal, a measure of urgency, scarcity, and supply chain constraint. A premium that rises while the paper price falls is especially revealing. That's the market saying the paper tape is weakening, but real-world buyers are still paying up for certainty. Ask yourself a simple question. If everything were truly abundant and smoothly deliverable, why would that happen? Now, there has to be a real bearish case here, because divergence can be dramatic without being structural. Refinery bottlenecks can create shortages of small bars and coins even when large bars are available. Shipping disruptions can delay deliveries and inflate local prices. Tax regimes and import restrictions can create persistent regional premiums that have little to do with global tightness. Retail panic can create a short-lived premium spike that fades as soon as buyers cool down. And paper markets can exaggerate moves because leverage turns emotion into velocity. When futures positions are crowded, a downside move can force liquidation, margin calls, risk, limits, systematic selling, creating an air pocket in price that doesn't reflect long-term fundamentals. Intervention risk also exists. Gold is a strategic market. Margin requirements can change, liquidity can thin, rules can be enforced more strictly, volatility can be amplified by policy headlines, so it's completely possible to see a divergence and then watch it heal. That's the bearish case. Now, here's what those risks don't change. A divergence that persists, widens across products, and shows up in multiple venues is rarely just a retail story. If the spread is persistent, it suggests the arbitrage pathway is impaired. If the arbitrage pathway is impaired, it means the market is pricing not just metal, but the reliability of settlement. And that's where the crossroads becomes real. Because if confidence and convenience remain dominant, paper will continue to set the marginal price and physical will follow. But if certainty becomes the priority, physical demand will start acting like gravity, pulling the paper price back toward the real-world cost of deliverable metal. That tug of war can last longer than expected. It can also end suddenly. And the way to avoid getting blindsided is not to guess a number. The way to avoid getting blindsided is to watch the signals that tell you which side is winning. Start with the screen price, but don't stop there. Watch volatility. A healthy bull market doesn't need violent candles every week. When the market starts printing sharp spikes and sharp reversals, it often means leverage is dominating the tape. Watch key technical behaviors. Many participants track the 50-day and 200-day moving averages to separate trend from noise. A strong market tends to reclaim those averages quickly after pullbacks. A fragile market tends to lose them and struggle to recover, especially if selling accelerates into obvious support zones. Watch momentum conditions. When markets get overextended, a pullback can happen even in the middle of a long-term bull trend. An overextension doesn't invalidate the thesis. It changes the timing risk. Then watch the physical layer. Watch premiums across multiple sources, not just one quote. Watch delivery times. When delivery times stretch, that's a real-world form of rationing. Watch product substitution. When buyers shift from one format to another because of scarcity, that tells you supply is constrained in practical ways. Watch regional differences. Gold is global, but it is also local. If one region consistently clears at a stronger price than another, it suggests demand pressure is concentrated, and that can drive flows. And watch the curve. Tight spreads, strong nearby delivery relative to deferred months, and persistent carry compression can signal urgency for prompt metal. In a calm regime, price means the marginal trade. In a stressed regime, price can mean the marginal force trade, while the real-world bid hides in premiums and availability. That's why it can feel like gold is telling two different stories at once. One story is on the screen: fast, emotional, leveraged. The other story is in the real world: slower, constrained, purpose-driven. Now, for different audiences, this crossroads matters in different ways. For someone holding physical gold as long-term insurance, the biggest risk often isn't daily volatility, it's sloppy planning. Authenticity, custody, liquidity planning, and concentration risk matter more than nailing the perfect entry point. If the role of gold is stability, then chasing short-term perfection can become the enemy of the objective. For traders, the divergence is a warning label about volatility regimes. If paper markets are whipping around while physical remains bid, that can create opportunity. But it also increases the risk of gaps, slippage, and violent reversals. In that environment, position sizing is not a detail, it's survival. Being right about direction doesn't help if leverage forces an exit at the worst moment. For investors considering paper exposure, the key is matching the vehicle to the goal. Futures and ETFs can be efficient for exposure, but they're not the same as possession. Paper instruments can behave perfectly under normal conditions, and then behave very differently under stress depending on structure, redemption mechanics, and liquidity. That's not good or bad, it's just reality. For people new to the entire topic, the best advantage is education before emotion. Learn what spot is. Learn what a premium is. Learn the difference between allocated and unallocated. Learn why bar formats matter. Learn how a market can be liquid on a screen and tight in the real world. Because the worst time to learn these mechanics is when everyone is shouting. Now, the crossroads question: does this divergence narrow, or does it persist? A narrowing divergence would likely look like this. Physical premiums compress, delivery times improve, and the curve normalizes as the urgency fades. A persistent divergence would look like this. Premiums stay elevated despite pullbacks, regional benchmarks remain firm, and the curve stays tight, implying real demand continues to prioritize immediate settlement. If the second path dominates, the implication is not automatic catastrophe. The implication is repricing pressure. When enough participants prefer certainty, the system starts to assign value to settlement itself, not just exposure. And once settlement becomes a valued feature, the market can behave differently for longer than the crowd expects. That's the difference between a trade and a regime. So the core message is simple, but it isn't comfortable. Gold can look like one price, while behaving like two. And the gap between those two prices, paper and physical, is where the real story often hides. Full risk disclosure: gold can be volatile, derivatives can amplify losses quickly, liquidity can vanish during stress, and no outcome is guaranteed. This is not financial advice. This is an educational framework meant to help analyze market structure, understand risk, and encourage independent verification. Because the people who get surprised aren't always the people who weren't watching gold. They're the people who are watching only one of its prices. And when a market reaches a crossroads, the difference between a number on a screen and metal that must be delivered becomes everything.